Hi there, my name is Michael Blanc, and if you're interested in apartment building investing, you're in the right place. So, in this episode, I'm going to talk to you about a technique where you can end up owning the majority of a building, an apartment building, even though you're using other people's money to buy it. All right, what do you get when you mix a value add apartment building deal, none of your own money, a preferred return for the investors, and a cash out refinance? Give up? Well, I'll give you the answer. The answer is you owning the majority of the apartment building without using any of your own money. So was that a little fast for you? That's okay. So I'm going to break this thing down here, and I'm going to show you how two different ways to structure a deal when you're buying an apartment building and you're using investors. Okay, so here's the setup. And there's going to be some numbers in here, so I'm going to stare at my notes just a little bit so I get my numbers straight here. But I don't want you to lose the main point, which is basically how you can end up owning the majority of the building, even though you bought it with investors. So here's the setup. You're buying an apartment building, okay, and there's a value add opportunity. You're raising rents by $100. You have to put in some work, but at the end of the day, over the course of 5 years, through the increased income and the value you're creating in the apartment building, you're actually creating equity of, let's say, $275,000. So let's say that's the setup. Now, there's two ways you can structure this deal with your investors. There's number one is a straight equity split, and number two is a kind of a preferred rate of return. And I'll explain this to you. But the first straight equity split is very simple, right? So you as a syndicator, let's say, retain 30% of the equity, and the investors get 70%. And we talked previously about you as a syndicator getting paid as a syndicator, why that you should get paid, and then different ways you can get paid. So take a look at that other episode about how to get paid, how to pay yourself for syndicating deals. So anyway, so in this case, straight equity split is you're getting 30% of the syndicator, the investors are getting 70%. So in this particular scenario, I'm just going to wave my hands a little bit because I have a fairly sophisticated model that I use for this that you can acquire as well on themichaelblanc.com. But I'm going to wave my hands a little bit because it's the main point, not the details that are important. The main point is this. So after 5 years, when you sell this, in this particular example, you're buying a building, and it's a 15-unit building. You're buying it for $530,000, and you raise $250,000. And over the course of time, when you cash out, you've actually raised the valuation of that building by $275,000 by increasing the rents. So let's say, in this particular case, you get 30% of all the cash flow distributions and 30% of the profit. So in 5 years, you will get about a $41,000 profit check when you sell, and over the course of 5 years, your distribution are going to be around $50,000 or $10,000 per year, right? For your 30% share. So that is fantastic. Number one, for not having your own money in the deal. Now, there's an even better option, and it's basically giving the investors a preferred rate of return. Now, what the heck is that? So a preferred rate of return is the investor, instead of getting a straight 70% split, what they do is they get a preferred rate of return. And I'll kind of, let's say you're giving them an 8% preferred return. What that means is that they're almost being paid an interest first, or they're getting paid out of all the cash flow that's available. 8% of what they put in has to be paid first before there's any kind of profit split. Now, normally in return for this, they get lower equity. So it's unusual for an investor to get, say, a 10% preferred rate of return and 70% equity. It happens all the time, but it's and I'll show you exactly why it's not really good for you to do that. But typically, the higher the preferred rate of return is, the lower the equity. So if someone is getting 10%, for example, preferred return, which is already in itself a pretty good return, then they might be very happy with any kind of small upside. So 10% return, 25% equity, right? So 10% preferred return, and then 25% of kind of upside. So most investors are very happy with that. But here's what happens. Now, the reason that you might not be so happy with that is the following. Because if you're doing, let's say, a 10% preferred return first, and the project doesn't quite go as you planned, and let's say there's not enough to distribute to actually pay out the 10% return, what happens is it starts accruing. So if you can only pay out, let's say, 5% this year, that means you owe the 10% next year plus the 5% from the previous year. And what happens is you never, as a syndicator, never actually get paid. And that's a problem over the long term, because why would I bust my butt with a project that I'm not getting paid? And so that's the issue with preferred rate of return. You have to be careful about that. So for the investors, that's fantastic. For you as a syndicator, not so much. All right. But here's the advantage of the preferred rate of return. So let's say you raise $250,000 and you're adding value. And let's say in 5 years, you're paying out a preferred rate of return, which is not good for you, so that your cash flow is lower. But let's say in 5 years, you've raised the value of the building, you do a cash out refinance, and you return the equity back to the investors. Now, in this case, let's say we raised $250,000 and we're paying a 10% preferred rate of return on that $250,000. That means out of the cash flow, the first 10% or $25,000 has to be returned to the investors before we do any kind of equity split or profit split. But once you do a cash out, and so let's say you do 10% to give the investors a 10%, good grief, 10% preferred return and 25% equity, let's say. Most investors would be happy with that because they're basically getting almost like a guaranteed payment plus 25% of the upside. So they're getting paid very, very well while their money is in a deal. But when you refinance and by adding value, this only works for value add deals, but you're adding a value, then you can return that $250,000 through the refinance to the investors. And now all of a sudden that preferred rate of return goes away, right? Because the preferred return is 10% of all the equity that's in the deal. 10% of $250,000 is $25,000 that you're paying out to the investors. But now the equity is gone. All their money is back. So the preferred rate of return is 10% of now zero. There is no preferred rate of return. Now the investor continues to have the 25% equity interest. That never changes. The equity never changes whether you do refinance or not. So in this particular case, this is fantastic because you end up, after doing the refinance, you end up with the majority of the building. Now, the investors are also happy, by the way, because they've already got their principal back. Their risk is off the table. So it's really kind of a win-win. Just remember, the downside is this only works for value add deal where you can do a cash out refinance. And remember, the downside is while this is going on, your compensation is going to be lower than a straight equity split. But it would be a very, very clever tool for you to end up over the course of 3 to 5 years, depending on when the cash out refinance is, for you actually as a syndicator to end up owning the majority of the building. All right, hope you found that useful. If you want more information about raising money, make sure you stop by and on my website, themichaelblank.com/ebook, and download my free ebook called The Secret to Raising Money to Buy Your First Apartment Building. That's themichaelblank, TheMichaelBlank/ebook. And it'll be a great resource if you're interested in raising money for your next deal. So thanks very much for your time, and I will catch you on the next episode. All right, take care. Hey, thanks so much for sticking around to the end of the video. I want to leave you with 3 next things to do. I'll give you a quick tour of those, and I'll tell you how to do them. Step number 1 is to download my free ebook, The Secret to Raising Money to Buy Your First Apartment Building Deal. It is an awesome ebook full of tips for raising money and how to do that. So that's number 1. Number 2 is to subscribe to my YouTube channel because I put out new videos all the time, and I'd hate for you to miss it. And number 3 is to watch the next video in line. All right, so what you're going to do is you're going to click on the first thing, which is to download the ebook. That'll open up a new tab. The video will stop playing. You're going to get the ebook, and then go back to this video, and then click on number 2, right, which is to subscribe on the channel. That'll open a new tab, and then you can go back to the third one and just click on the next video in line. All right, so hope you find that helpful, and I'll see you in the next video.